Hello students and welcome to my YouTube channel. Before you begin to see this video, I would request you to please go back and check one of my video which talks about the concept of mark to market. In this question, we are going to discuss about the calculation that how do this mark to market happens in any margin account which the investor need to open with the exchange houses. So, if you remember, I have discussed about this book, Option Futures and Other Derivatives of John C. Hull of Pearson Publication. Must read book. And I'm going to discuss the question from one of the resources which belongs to this book only. So let's see that what is the question and how do we do and understand the calculation part of it. So here in the question, the investor is interested in buying the gold future contract. So the underlying asset for this future contract is gold, and he plans to buy two contract. And because how do I know that he's planning to buy? Because from this word long, which means buy. So he planned to buy two contract. The size of the contract is 100 ounces. So he's buying two contract. 2 into 100 will give him 200 ounces of contract. Future price which is given is 1450, and here you can see that initial margin requirement that is required for you to start doing your transaction, to start executing your trade, which is 6,000 per contract. So the exchange has asked that if you wanted to buy and enter into this future contract, you have to deposit 12,000 for two contract as an initial margin. Only then we will allow you to do the trading. Only then we will allow you to buy and enter into the trading part of it. And then there is a concept which we call it as a maintenance margin, which means that it's a kind of a minimum balance that every time an investor have to keep in his account. So altogether, this investor for two contract have to maintain 9,000 in total into this account. So let's see. For the purpose of understanding, I have actually created a margin account for both long position holder as well as short position holder. I'll try to explain you first with long position, and then it will become very easy for you to understand this short position. Right now, long position means that he planned to buy two future contract, and he has already deposited 12,000 dollars as an initial margin. The future price which was given in our question was 1450. Right now, let's ask a question that what is always a fear of a buyer, or let me ask this question in this way, that what do a buyer always want? To buy things at a higher prices or to buy things at a lower prices? So definitely the second one, that always as a buyer I wanted to shell out less money and get the maximum benefit, right? So what is always the fear of a buyer is a bullishness that is there in the market, right? So, in order to hedge its position, the investors are entering into a derivatives market because it's a tradable instrument. So, at least they can manage their risk, which they might be exposed in some other market. So now, if the fear only comes true, whenever the fear of the buyer will come true and he has hedged himself, only then the payoff will will come back to him. Only then the benefit or the profitability will come to him. The gain will come to him only when his fear will come true, right? Let's see, is his fear coming true here? So second day, and this is usually the settlement price, that how do mark to market happens every day whatsoever the transaction that takes place, that by the end of the business hour there is a settlement price which these clearing houses try to settle. So if there is a gain, you will have more money in your account. If there is a loss, your account balance will get deducted, and this keeps on happening whatsoever is the time period of your derivatives instrument. In our example, it is a 6-month period. So here on the right, on the second day, we found that the fear of the buyer is not coming true. Instead of the price going up, the price is coming down. And if the prices are coming down, then he will definitely incur a loss. How is he incurring a loss? Because what was the price? 1450. And what is the price at the end of the day? 1441. This means there is a dip of 9, right? There is a loss of $9. and multiplied by 200, which is basically the size of the contract. If you remember, one FC, one contract was of 100 ounces, right? 100 ounces, so two contract of 200. So he is having a loss of 1,800. Why is having a loss of 1,800? Because 1450, that is basically the fixed price. He would have bought that as 1450. But what has happened today? The settlement price has become 1441, right? So it has a loss for him because it has not gone up. It has further reduced. So if it has reduced, the daily loss for me today on the second day, end of the second day, will be 1,800. Cumulative is also 1,800, and then my margin account balance have gone down by 1,800, right? How do we got this? 10,200, so it is 12,000 minus 1,800. So because 1,800 is a loss, my account balance have gone down, and now the account balance is 10,200. Again, on the third day I was very optimistic, but let's see what again has happened. So again the prices has gone down. Again it has gone down, means it is a loss for me. Why it is a loss? Because yesterday the price was 1441, and today, at the end of the day, the price has become 1.38.30, right on the second day. How much is the difference? The difference, it is coming as 2.7 times 200. This means altogether 540. Again, it's a loss for me. So it's a loss for me. Cumulative, if you see on what basis, how are we getting this 2340? So basically, this 2340 I am getting. Let me just show you this in terms of a down. So on what basis I am going to get this 2 3? So earlier I had a loss of 1,800 plus again I had a loss of 540, which together means 2340. Because it's a loss, so I'm writing this as minus sign. How do I got this 9960? Because what was my account balance? My account balance was 10,200. How much? Again, this today I have a loss. I have a loss of 540, which has given me this figure. Fourthly, I was expecting the same thing, that maybe bullishness is there. Unfortunately, bullishness is not there. So again, you have seen that the prices has gone down. This time, how much is the dip that has taken place in terms of the prices? It is 2.1, right? How do we got this 2.1? Again, I'll show you that how we have got this 2.1. So what was the previous price? 1438.30. What is the price at 1436.20? If you equal it, let me just clean some area. Okay, so this is gone and this is also gone. So the difference that will come your way will be 2.1 times again 200, and you will get your answer as 420. Again, this is a loss because prices are coming down. So how much is the cumulative? 2340 plus 420, which will give you this value. On what basis? How do I got this 9240? Simple. What was your account balance? 9660 minus how much is the loss that came to you? 420. If you minus this, you are going to get this answer, this 92. Now, something strange that is going to happen on the fifth day. Okay, so I'm going to delete this information. I just need some space to write. So this is gone. Okay. Now let's see what is that strange thing that has happened on the fifth day. Fifth day, again there is a dip that is taking place, right? And let's see how much is that dip. So what was the previous price? 1436.20. What is the settlement price on the fifth day? It is 1429.90, right? And if I ask that how much is the difference, so the difference is coming. Oh, sorry, I think I missed something. Okay, so how much is the difference that is coming? So let me calculate this difference. 1436.20 minus 1429.90. So difference is coming for 6.3. 6.3 times 200, it will give me 1260, which is this value. Again, it's a loss. Now, the thing that what is happening here, think about it. If this trade will get executed, right? I'll again repeat, if this trade will get executed, what will happen? How much is my balance? 9240, correct? Which is this. How much is the loss I incurred right at the end of the fifth day? Sorry, it is 1260. If this trade will get executed, this means from my 9240 will get further reduced. So 9240 minus 1260, my account balance will go to 7980. And that is the reason it is highlighted. It is highlighted as yellow. Why? Because trade is not possible. Why the trade is not possible? Because here I will be asked to pay the variation margin. Okay, what is happening here? I'll just simply write what's happening here. It is going down. It is going down of what was, if you remember, what was the maintenance margin? The maintenance margin was 9000, and if this trade will get executed, my account balance will come below 9000, which is showing me that 7980. Therefore, I will get a call, which I will call it as a margin call. Okay, what is that margin call? Margin call is a call given by the exchange house to the investor that we can't execute your trade unless you pay us the variation margin, right? What is this variation margin? Variation margin is the amount of money that you have to pay to the exchange to match it up with your initial margin. So if I ask that 7980, this is not executed because I have a loss. So how much money should I pay you? Right? What should be the variation margin? So variation margin will come as altogether 12,000. Here you have to maintain your initial. Let me just write that instead of writing this. I will do one thing. So variation margin of 4020 is given. Why 4020? Now you may ask a question that why 4020, and from where are we getting this 40 and 20? So simply you have to pay that much amount to the exchange, which will match up your account balance to 12,000, right? So what do I need? I need 12,000. This means I have to deposit how much money that you are already having if this trade will get executed. 79, if 79 will get executed, if this trade will get executed. So if you just simply find out 7980, you're going to get a difference of 4020. Now, sometimes it becomes very confusing for the student to understand. That is also one of the reason I don't very much vouch this method of calculating it. Right. So for me, there is a different way of calculating. So let me show you that how do I calculate that variation margin. Okay, so I wanted to know that how much is the variation margin that exchange is supposed to that I'm supposed to pay to the exchange. It's very easy. Find out whatsoever is your cumulative gain. Okay, it's very easy. So if at all I have consecutive days, I am getting losses and losses and losses. So I just need to check it out. How much is my cumulative loss and cumulative gain column, right? This is 4020. This means that if I'm going to pay this 4020, I'm going to match up with 12,000, which is perhaps very easy one to understand. Or you can go with the another option just now, which I told you, that you may just find out the difference between 12,000 and then the trade, which has basically put on hold your account balance, right? So 7980, even the difference between this is 4020. The moment you will deposit more money, so what will happen? This, if you just pay attention that from how do we got this value. This value you are getting because you have paid 40 you have paid 4020, which means 12,000 account balance. Plus, there is something else that has happened on the sixth day. There is an increase in price, right? There is an increase in price. So from 1429.90, the today's price is 143.80, which means that it has gone up by zero point 0.9 times 200 will give you 180, and this 180 is a profit or a gain, right? And that is the reason it is not in minus. So I already deposited 4020, my account balance became this, plus by the end of the sixth day I got, that is the reason my account balance is reflecting as 12,180. Again, to my bad luck, on the seventh day, at the end of the 7 days, that settlement price was again 1426. Here you can see that again I had a loss. So again, this is all cumulative loss that has, here at least something has improved. Right now, you may ask a question that how do we got this 38, this value of 3840. So I'll just show you that how we have got this value. So I'll show you here that what was that overall loss. So 4020, correct? 4020. I had a gain of 180. So when I have a gain of 180, what will happen? This was in minus, correct? I had a gain, so this will become in plus. And if you simplify this, you are going to get 3840, but still you will be at minus because you have more losses. So 3840. And further again 780, so it has become 460. So in this way, your margin account. So as of now, if you ask me right at the end of the seventh day, how much is the margin account balance which is there in my margin account? It is 11,400, which is this value. So in this one, to a bad luck of this long position holder, the prices, his fear is not coming true, and it is simply, nose diving like anything. And because of this, his account balances completely keep on changing the position. Now I will quickly take you back. I believe that if once you have understood this, it's very easy for you to understand the short position holder, because for the same contract, if the long position loss eventually become the profit for the short position. So here, if I just ask you that he has also deposited for the same thing, he has also deposited 12,000 as an initial margin, which is this one. And then the prices, it's the same thing. The prices is nosedive, right? Now he is having a short position. So as a seller, always what do you want? Seller always want that prices should go up, right? Prices should always go up. So short position want hike in price, right? Hike in price. So what is their fear? So fear is bearishness. In order to safeguard themselves against this market mood or of bearishness, they wanted to enter into a contract, which this person have done, right? Now let's see bearishness that is there in the market. He will have a profit only once his fear will come true. This is the magic mantra of financial derivatives payoff. Okay, you should know the fear of the position holder. So what was the why he wanted to enter into a short position? Because he has a fear. What is the fear? As a seller, he has a fear that the prices will go down. In order to hedge himself, he has entered into a derivative instrument. So is his fear is coming true? That what exactly you have to ask. Check it out. Is his fear coming true? Yes, 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 and further yes. Only this area his fear didn't came true, right? So if you see the account balance that we are calculating for him, so 12,000, then his fear came true. So he had a profit of, on what basis he got a profit? It's the same thing. How much is a dip? 1450 minus 1441 is equal to 9 times 200. This 1800 is his gain, right? That's how we have got gain. And that is the reason 12,000, it's a gain. So 13,800. And you know the best part of it? He can withdraw the excess money. So if he wanted to withdraw whatsoever the money that he wanted to withdraw, he can withdraw, provided that it should not go below the maintenance margin. And also, but natural that he should have that much of money in his margin account, which will allow him to trade, right? Similarly, the prices has gone down every time he is having profitability. and you can see that it is increasing. His account balance is increasing because he has a profitability. The only area where the account balance is going down is this, because his fear is coming true, because 1429.90 minus 1430.80, if you just simply calculate the difference here, you will come to know about it, that how much is the difference. So the difference will be, it is zero point 0.9, and it is basically, the prices is increasing. So I'm just comparing from previous to this. The prices is increasing from 29, it is getting 30. His fear is coming true. The moment his fear is coming true, actually, that is, his fear is actually, no, sorry, I'm sorry, his fear is actually not coming true, because there is no bearishness in the market. There is no bullishness in the market. It's basically bearishness. So from 1429, the prices has gone up to 1430. He was expecting bearishness. Market has gone bullishness, and therefore he had a loss of 180. So if you multiply this, he will have a loss of 180. This is a loss. So from this, it will get minus, so he is having an accumulative gain and loss of, so it is all gain, so he still have 3840. If you can see, he's having, after doing all of those things, his account balance is shown as 16,620. He is at his best position, because he was expecting, actually his fear is coming true. As a seller, he had a fear that the prices will come down, and literally the prices came down, and because he has entered into a contract, he is reaping the best of the best benefit of all of these volatility. So that's all from my side. Please revisit the previous video on the concept of mark to market. Probably only then you will be able to understand. Please keep on learning, keep watching, and do let me know what else do you want in financial derivatives. I'll be happy to help. Thank you.